Hey everyone, it's Natalie, and today is October 1st, 2020. And we're going to be talking about wondering if your bank is a junk bond. Sorry about that background noise. Wondering if your bank is a junk bond, the October surprise, and also bond liquidity problems. Now, you might say, oh my God, this sounds very dull and boring, but the truth is, it's not that dull and boring because it is key and essential to preserving your wealth. So if you have a 401k or an IRA or a managed brokerage account or a checking account or a savings account or a money market account, these things are very relevant. And I'll tell you what's going on, but I will also tell you how you can make sure that you are the boss of your money and you are not subject to the problems that can come up when you rely upon salesmen. Okay, we'll be right back. Okay, so let's start off by talking about, is your bank a junk bond? Now, what was interesting is I was doing a study and I was researching because, as you know, I've been telling you that over 1/2 of the S&P 500 companies are at or near junk bond status. What does that mean? Well, junk bonds have a higher risk of default, of going bankrupt, of not paying people back. So it's pretty important to know whether or not your bank might be close to that status, wouldn't you say? So let's take a look at it. I'm going to share the screen. I'm going to tell you where you can get this data and what it means for you and how you can protect yourself and why you need to know about it. So let's look at it. All right, so the first thing that I want to share with you is you can access this blog. Go to nataliepace.com/blog. And it is the first one that comes up, or you can search for September 30th. I posted it yesterday. So let's take a quick look. So 14 out of 18 banks that are examined by the Federal Reserve and submitted to stress tests. Here's a list of them. Now you may say that it's a Greek to me, but BBB is one rung above junk bond status, and A, just one A, is two rungs above it. So if any of these banks get a downgrade, they're a junk bond. If these banks get two downgrades, they're a junk bond. And of course, the one that's closest to that downgrade might be Ally, Discover, Capital One. Also, I want you to just be aware of the fact that this is pretty important. And why is that? Well, the main reason that this is so important for you to know, outside of the fact that, you would want to know which one of these banks are more fiscally responsible, which ones have been using financial engineering or a little riskier, etc. Not because you have to worry about your FDIC insured cash getting lost somewhere. I wanted to remind you that over 400 banks actually did go belly up in the Great Recession. And what happened to most of the depositors is that they simply saw a different name on the door. So it's not that you're all of a sudden going to scramble for your cash, most likely. But there are reasons why these banks that are closer to junk bond status are a little riskier for you. And that has to do more with the money market funds. So I will give you my personal experience. I was offered by one of the A-rated banks a product, a money market product that was going to yield me something like, I don't know, 1.5%, a little bit above nothing. And I said, is it FDIC insured? And they said, no. And it was offered by one of the banks that is very close to junk bond status. And it is also a money market fund. So there's a whole lot of things there. So the first thing was offered a bank product that is not FDIC insured. So number one, no matter what bank product you have to verify that it's FDIC insured, especially if it's a money market fund or a high yield CD. Insurance products that are sold by the bank are not FDIC insured. So if you purchase an annuity or any other kind of insurance product from a bank, it is not FDIC insured. But it is possible to purchase a money market fund or a CD that is not FDIC insured as well. So that's number one, is that you have to read the fine print and make sure that it's FDIC insured if you care about that sort of thing. Number two, if it's a money market fund, they now can have redemption gates and liquidity fees. So what does that mean? Well, it means that you might not be able to get access to your money. That's the redemption gate, or they might charge you money to have access to your money. So you're getting paid almost nothing, and then they're going to charge you fees. That's not a good thing. And by the way, that's what a lot going on with a lot of high yield CDs. High yield, it might only be like 2%. And then your penalty, if you need the money before the end date, which is going to be a long time from now, then, you know, that could be much higher than that very tiny yield that you're getting. So I want to just say, we spend one full day at our investor educational retreats talking about what's safe. And I would say it's a two-step process. This is the Cliff Notes, because obviously we spend one day and I'm now spending 1 minute. The Cliff Note version is this. It's a good idea to keep your money and to have access to it. So that would be FDIC insured cash. That's the first step only, because hard assets can hold their value better than paper assets when there is too much leverage going on, which is the case in today's world. So when everybody owes too much money and there's bound to be a little bit of restructuring and a lot of changes, hard assets, especially income producing hard assets that you purchase for a good price, considering how the income is going to be generated in a post-pandemic world, that's the magic. So again, first keep your money and then see if you can find a safe income producing hard asset that you purchase for a good price, and that it would all be considering a post-pandemic world. There are things that you're not thinking about that would be a very good idea, and there are things you might be lured into that are not a very good idea. So it is a good idea to get educated. All right, so redemption gates and liquidity fees make money market funds much riskier, and they're not paying you for that risk. FDIC insured cash can be very essential, but it's not guaranteed unless you look at the fine print of your products. So let's move on to the October surprise. So this quarter, or the second quarter of 2020, was a contraction of 31.4%. The first quarter was a contraction of 5%. So that's a recession, 2 quarters of contraction. Everybody knows that. Now the third quarter is because the full year is predicted to be 3.7% contraction. That's lower than the first or the second quarter. So the only way that we get to a 3.7% contraction in the full year is if the third and the fourth quarters look pretty darn good. On average, they'd have to be about 16% to get us there. So the October surprise will happen October 29th, 2020. That's when the Bureau of Economic Analysis, BEA.gov, is going to issue the advance numbers for the third quarter of 2020 GDP growth. Now, once that happens, you're going to hear the White House and the administration tooting their own horn, saying, look at that, that's the best GDP growth that we have had in decades. Well, the truth is, it's a recovery from the worst GDP contraction than we have seen in our lifetime, and probably since the Great Depression. So we only go back recorded GDP to 1974, but everybody's saying this could be even worse than the Great Depression. Now, you might say, okay, well, what about my stocks? Are they going to go crazy? Well, the truth is that that kind of recovery is already priced into stocks. Stocks are still very, very expensive. The other side of the equation is that the economy has actually changed and it's being propped up. So that number would be a lot worse if we didn't have a moratorium on evictions and foreclosures. It would also be a lot worse if we hadn't paid a lot of airline employees, even though they weren't working. So there's a lot of people who stayed on the company payroll who were not working. And in fact, that's what all the brouhaha in Congress is about yesterday and today, was extending benefits to people who are not working, such as a boatload of airline workers, including at least 30,000 of them. Disney laid off a boatload. I think it was probably 28,000 employees. So things have shifted. Autos, airlines, hotels, office buildings, things have shifted. People are living in a changed world. They don't feel safe working, in cubicles next to people with processed air when they know that it's healthier to be outside or in their own home. So this idea that we're going to all go back to work and things are going to go the way they were and we'll continue traveling to conventions, not really realistic, at least until we feel safe enough to do so. So it's important for you to remember that. So yes, we're going to have a huge October surprise. That's a week before the election. Yes, it could affect the election results, because anybody who thinks that the current administration is doing great because they have this outstanding GDP results at the end of October might be, anybody on the fence might be tempted to just go with the current because they would think that he's doing great. He's not going to say this is a recovery from the worst contraction on record, and that's why it looks so good. He's not going to say that. He's going to say, look what I did. This is the greatest that we've ever seen in our lifetime, blah, blah, blah. So just be aware of that. And the reason for that is that the average recession takes 18 to 24 months to recover from. And most people, most of the administration, doesn't matter who's in office, and the Treasury Secretary and the Federal Reserve Board all want prices to stay stable. They want stock prices to stay where they are. They want real estate prices to stay where they are. And the only way that happens is if you do not sell. So they want to say anything to keep you from doing that. Toward that end, again, moratorium on evictions and foreclosures, giving money to employees that are no longer working, and also buying up 1,000 bonds from companies that were using financial engineering. What's that? They were borrowing money very cheaply, letting their own credit score fall to the lowest rung of investment grade or even below, which Ford got downgraded. And they were using the money to buy back their own stock and pay dividends. That is not economic growth. That's financial engineering. What is economic growth? Productivity. It's inventing and building and selling the products of tomorrow, not the products of yesterday. If America was relying on sales of typewriters and horse and buggy, we'd be in real trouble. We are excelling right now in certain areas such as technology because we keep inventing the products of tomorrow. So we need to make sure that those employees that are not working but are getting paid for it actually can find a job creating things that people want and need in a post-pandemic world. All right, off the soapbox. Let's go on to the next topic, which is bond liquidity. Sorry, this may seem like it's boring, but it shouldn't be, because for most of you, if you have a 401k or an IRA or a managed brokerage account, you have bonds and they are sold to you as safe. So it's really important for you to know the truth about bonds, because and you should watch this interview. I interviewed Kathy Jones. She's the chief fixed income strategist at Charles Schwab. I interviewed her, I believe, in August, and she revealed, which is true, that bonds are negative yielding. In other words, you're losing money. Negative yield means you're losing money. So if you buy a bond and it's 30 years, and by the way, if you're 50 and 30 or 40 years from now, how old are you going to be really? Do you really want to loan something for that long of time, especially at 3%? So nobody's going to want to buy that from you. And that's what bond liquidity means, is that people are getting sold into bonds that nobody else wants to buy back from them. And then you're going to have to hold it to term. And if they have to restructure the debt in the meantime, you're going to lose even more money. If you want to sell it in the meantime, you're going to have trouble selling it. And when you do sell it, you may have to sell it for a much lower price than you bought it for. So let me show you the bond liquidity and what that means. I'll show you the chart. Here we go. All right, so this is that blog. And by the way, there's also an important blog that you might want to check out, which is about the election. So does the stock market in general fare better under Republicans or Democrats? I think this is a good one to read so that you empower yourself. There's revealing stuff in there that I think is really key. So here's the liquidity data. Again, it's as of September. And as you can see, the most illiquid market is bonds. And by the way, muni bonds fall into this as well. So what illiquidity means is that if you buy something, you want to be able to sell it. If you can sell it fast, then it's liquid. So stocks are pretty liquid, treasuries short term are liquid, gold is liquid, bonds not liquid. And what that means is that if you want to sell that bond, you're going to have to take a big haircut. So you're going to have to lose a lot of money. That's a big negative yielding. Now, I also wanted to show you that was the same thing back in December of 2019. So this was the case before the pandemic, that bonds were illiquid. Okay. And by the way, the Dow Jones wasn't that liquid at that point too, which is probably why, and this was before the great, the big drop from February 19th to March 23rd. So stocks have become more liquid recently than they were then, but you could see that they were really having a problem. And in particular, it was the Dow that was having the bigger problem. Actually, the S&P 500 was doing much better than the Dow, and this more recent chart is not showing us the Dow, it's just showing this S&P. So bottom line is that liquidity is good and illiquidity is not good. And if you're being sold into long-term bonds, that could be very not so good. So you need to know where your cash is and read the fine print. You need to know what is happening with the safe side of your 401k or your IRA or your managed brokerage account or your annuity. And you need to be prepared that we're going to have very good economic news at the end of October, which is already priced in to the stock market, but it could affect the election. So be wary of that. If you care one way or the other, then you're going to want to share it with everybody to get them to vote for your person, or you're going to want to forewarn people that this is propped up financial engineering. Again, if you read the election article, what you'll see is that mostly this has to do with business cycles more than presidents. Although I will say this in summation, when presidents start wars, that is very bad for the economy. When they impose tariffs, that is usually very bad for the economy. So, we have had a series of wars, not under this current president, but his predecessor, and not the Democrat, but the Republican counterpart. And that's very bad for the economy. That's very, very costly. In fact, that's how the United Kingdom lost their global reserve currency status. We still are the biggest global currency reserve above the euro. There is more of a basket, but the US is the biggest part of that basket. And we do have a lot of strengths in our economy, but we have a lot of challenges. So the bottom line is that it takes about 18 to 24 months in an average recession to recover. Stocks are overpriced right now. Bonds are illiquid. So you really need to know what you own, and now would be a very good time to fix the roof while the sun is still shining, because if you wait for the headlines that either your bond or your stocks are in trouble, it will be too late to protect yourself. So wisdom is the cure, the time is now. The 4th edition of the ABCs of Money will be out mid-October. Please share, review, read it. Also, if you want to know what you own now, you can get a second opinion. Call 310-430-2397 or email info@nataliepace.com. If you have over $100,000 in your nest egg, you want a second opinion now. You want to do it before the election, not because it matters who gets elected, but just because, it does matter, and especially matters to you because you have a candidate that you desire the most. But what does really matter is that people are in a holding pattern. And a lot of them want to do something after the election. Now you might say, well, maybe they're going to buy more because of this great surprise that we're going to have. But the truth is that's already priced in. And in the last 2 recessions, we did not have a Santa rally. So just be aware of that it's very possible that we will not have a Santa rally. Now you might say, well, gosh, what do I do in that scenario where we could have a Santa rally or we may not? Historically, we would not. And it's also possible that we could. So what do? You have a well-diversified plan. And that's why it's easy as a pie chart. So again, I teach about that. You can read about it in the ABCs of Money. You're going to get that along with an action plan in the second opinion, and you can learn it yourself at the Investor Educational Retreat. That's going to be October 3rd through the 5th, 2020. So it's this weekend. You got to move now. Simply go to nataliepace.com. I'm going to show you how easy it is. And I mean, obviously, if you want to register and you know that you want to register, then you're going to need to call our offices now, or you're going to email info@nataliepace.com now. But if you'd like to learn more first, then simply go to nataliepace.com and then scroll down, and then you'll see the banner ad. Click on that. And you'll learn more about what you're going to learn at the retreat. You'll learn the hours, you'll learn the pricing, you'll read testimonials. And then call 310-430-2397 or email info@nataliepace.com to either ask your questions. Of course, we want you to make an informed choice, or register. Also, if you, right now, the 3rd edition of the ABCs of Money is up there. Just click on that and you can buy it. It's $3.50 on Kindle. So it doesn't hurt for you to read that now and then read the 4th edition in 2 weeks. If you want to wait, no problem. All right, so you know what to do. And the one thing you do not want to do is be complacent or have blind faith that the broker salesman is doing it for you, because they may not even know any of the things that I just told you about. And if you ask them about it, they are going to want to allay your fears so that you don't do anything at this time, because that's what the feds want. The feds want, it's called the price rule. They want to keep real estate prices and stock prices and bond prices all exactly where they are. And the only way they do that is if you don't take any action. However, you should take the action that's in your best interest. And we collectively should do what's in our best interest, not necessarily bailing out last century products, but investing in the products, goods, and services that are needed in a post-pandemic world, and to become a productive economy again instead of a propped up economy. Thank you for joining me. I will see you maybe this month another time, and definitely in November. All right, 310-430-2397 or email info@nataliepace.com. Remember, you can watch these video conferences back at youtube.com/Natalie Pace. So my YouTube channel. Thank you again. Goodbye now.